Hi everyone. First and foremost, I want to welcome and thank everyone for attending our podcast today. My name is Vidya Kushenko, an analyst for the analyst team at lee-chandler, and today I am joined by my colleague, Daniel Murphy. So finding a type loan can be struggle since there are many of them, and it is important to understand how they work so you can pick out a perfect one for your purpose. So with that, today we will talk about the different types of mortgage. To begin, I will talk about the 30 years fixed rate and the 15-year fixed rate loan. There are a variety of mortgages available, but for most of home buyers, in practice, the 30 years fixed rate and the 15-year fixed rate mortgage are the most popular. These loans are structurally similar. The main difference is the term. While a 30 years mortgage can make your monthly payments more affordable, a 15-year mortgage generally costs less in the long run. Let's take a look at the 30 years mortgage. In this kind of mortgage, the balance shrinks much more slowly because the home buyer is borrowing the same amount of money for twice as long. In fact, it's more than twice as long because for a 30 years mortgage, the principal balance does not decline as fast as it does for a 15 years loan. So the higher the interest rate, the greater the gap between the two mortgages. When the interest rate is 4%, for example, the borrower actually pays almost 2.2 times more interest to borrow the same amount of principal over 30 years compared with a 15 years loan. Next, we will move on to the 15 years mortgage. So normally, consumers pay less on a 15-year mortgage, anywhere from a quarter of a percent to a full percent. And over the decades, imagine a 300,000 loan available at 4% of 30 years or at 3.25% for 15 years. The combined effect of a faster amortization and the lower interest rate mean that borrowing the money for just 15 years could cost over around 79,400 compared with 215,600 over 30 years, or nearly two-thirds less. If you want to know which one suits you best, let's take a look at the two types, benefit and the drawbacks. With the 15 years mortgage, the advantages are the interest rate is typically lower, and there's much less interest paid over the life of your loan, and obviously the loan pay is off is sooner. The advantages of the 15 years mortgage are the monthly payments are higher, and it can be harder for you to qualify for. On the other hand, things are advantages for 15-year mortgage seem to be disadvantages for 30 years mortgage and vice versa. With the 30 years mortgage, the pros are monthly payments are lower, and there's potential more money available for emergency. And then it's lower income qualification. About the cons, it's gonna be the interest is typically higher. The loan take longer to pay off, and there's much more interest paid versus a shorter term loan. And next, Daniel will speak on the differences between fixed and adjustable rate.
So first, looking at the fixed rate, the main point is that the interest rate stays the same throughout the term of the loan. So whether it's 15-year or 30-year mortgage, and initially there more goes towards the interest rate than the principal, and that changes throughout the term of the loan. For the adjustable rate, the rates will change throughout the term of the loan. So you are kind of taking an extra risk with the interest rate risk, whether rates are going to rise or fall throughout the 15 or 30-year term of the loan. Comparing them, for fixed rate, the rates never change. It's a little bit easier to budget because you know what your payment's going to stay the same throughout than with the adjustable rate. It's also easier to compare offers from different lenders because it's just simply looking at the rate and seeing the difference in the rate and the payment throughout. And additionally, you can also refinance throughout if the rates were to fall, and you can go through the refinancing process. With the adjustable rate, the rates will change. There's also a lower initial rate than with the fixed rate, which also creates a lower initial payment on the mortgage. Also, with the adjustable rate, there are more housing options for you because you can borrow more when you're using an adjustable rate. So if there's a property that you're interested in that you can't get with a fixed rate, you may be able to use an adjustable rate mortgage, and that may give you the extra funds to be able to purchase the property. Because you can borrow more, it's also easier to qualify for the adjustable rate than the fixed rate. But at the same time, it's harder to budget and know what your monthly payments are going to be throughout the entire term of the loan. So I think that when choosing one, it really just comes down to if you're willing to take the interest rate risk for more funds, then an adjustable rate is for you. If you're more comfortable and it's more simple for you to take the fixed rate, knowing what your payment to month, if that makes you more comfortable, then I would suggest going with a fixed rate mortgage. And thank you for attending our podcast.